Good afternoon, everybody. Welcome to Liberty Call. Today is Tuesday, May 22nd, 2023. Hope everybody's having a fantastical day out there. I am Raymond Dahlman, your humble host here at the Liberty Call. And not a great day in the markets. I mean, it's better than it was earlier this morning. I mean, the Dow was down about 1.5% or around 500 points. But, things came back a little bit. But, it looks like our domestic indexes we're more than 1% down. It's probably everyone freaking out because the Fed is going to have their, they're in the middle of their current meeting right now. So we'll see what happens. Anyways. All right. Well, I already see I got a thumbs up from somebody out there. So Sophia, Anna, whoever that is. Thank you, Sophia. If it's your first time watching the Liberty Call, please give me some thumbs up, likes, shares, subscribes, follows, all that good stuff. I would greatly appreciate it. So let's go ahead and jump into the numbers and, ignore my dog back here. We were outside playing for about 40 minutes waiting for the market to close, and he's exhausted right now, but he's pooped back here. So anyways, let's go ahead and jump into the numbers and see how they look. All right. Dow Jones was down 1.08%, 367 points, closed at 33,684. The S&P 500 was down 1.17%, closed at 4119. NASDAQ was down 1.09%, 132 points, closed at 12,080. The VIX was up 10.45% today. It's currently up to 1776, so not quite to 20 yet. That's usually where I really start to worry, but with everything going on in the world, I mean, be cautious right now, folks. Let's see. Canada was down 1.01%. Brazil was down 2.42%, and Mexico was flat at up 0.02%. Over in Europe, I see lots and lots of 1% downs. So starting out with Germany, they were down 1.23%. UK was down 1.24%. France was down 1.45%. Netherlands was down 1.87%. Spain was down 1.72% for the day. Italy was down 1.65%. Switzerland only down 0.12%, and Portugal down 1.41%. Over in Russia, both exchanges were in the red. The MOEX was down 2.07%. The RTSI was down 1.34%. And the overnights in Asia, starting out with the Nikkei in Japan, it was up 0.12%. Australia was down 0.92%. New Zealand was up 0.14%. Chinese markets, mostly green, as far as I can see just at a glance. The Shanghai was up 1.14%. The Shenzhen component up 1.08%. China A50 up 0.77%. No, these aren't changed. So belay my last, starting with the Shanghai. The only Chinese market that was open today was the Hang Seng, and it was up 0.2%, and the Taiwan weighted up 0.37%. They should grade these out or something. I mean, I'm reading through this really, really fast. So, all right. So again, not great, but not the end of the world. All right, let's go ahead and jump on over to today's market recap. S&P 500 slumps as sea of red in banks rattles investors. Fed meeting is underway. All right, get my notes here. The S&P 500 fell on Tuesday, driven by a sharp decline in regional banking stocks and concerns that the U.S. could default on its debt repayments as early as June 1st if Congress fails to lift the debt ceiling. And I saw an article earlier, a headline that said that Biden was not going to meet or not going to discuss the debt ceiling at their, I think, May 9th meeting with Congress. Why are you waiting? I mean, I personally don't care. Default. The government can fall apart for all I care. I'd like to, stop being robbed of a third of everything I make from the federal government, which does zero for me. All right, let's get back to the news. Treasury Secretary Janet Yellen, dumbest human on the planet, issued the warning in a letter to House Speaker Kevin McCarthy on Monday, stating that the U.S. could run out of cash and default on its debt obligations by early June if the debt limit is not raised or suspended. This comes just as the Federal Reserve started its two-day meeting, with markets expecting a 0.25% hike in rates on Wednesday. However, the Fed signaling on a potential pause will dominate investor attention. Everyone wants the Fed to pause. They'd really love them for the lower interest rates and start printing money, but I don't think they're going to do that. They'd probably get drug out of the Federal Reserve by their collars if that were to happen. But anyways, banking stocks were the worst performers, with regional banks such as PacWest and Western Alliance Bancorp tumbling amid worries about further stress in small lenders exposed to long duration assets, including treasuries and commercial loans. Despite this, Wells Fargo stated that it did not anticipate a banking crisis, saying that the vulnerability to rising interest rates varies greatly across the banking industry. Energy stocks also fell due to a slump in oil prices amid fresh concerns about the economy. Halliburton Company, APA Corporation, and Schlumberger were among the biggest decliners. Consumer discretionary stocks were relative outperformers, buoyed by a rise in Amazon and a jump in Marriott International's quarterly results that topped Wall Street estimates. Uber saw an 11% surge in its stock after reporting a smaller than expected loss in the first quarter and providing an upbeat outlook. However, Chegg's stock plummeted 50% after reporting better than expected quarterly results, but warning that AI language program ChatGPT is threatening the health of its homework help business. In economic news, labor market demand cooled as job openings fell to a 2-year low in March, easing concerns about a wage-led inflation. Let's see here. The decline in job openings may have been due to a mismatch in worker skills and employer requirements or a delay in posting job vacancies amid the pandemic. I mean, come on, the pandemic's been over for years, if it was even really here. Despite Cummins Inc. lifting its annual revenue outlook and beating quarterly results, its stock fell by 3%. All right. Are there still people out there wearing rags on their faces? I'm curious. I mean, I've never even gotten sick. I mean, I had a cold when my wife came back from Europe, like, was that last fall when I was having like my stomach issues? But, most of my problems were from taking red dye number 40 and it was like ripping up my guts. So now that I figured that out, I'm not having any more problems. Well, I'm getting over taking Benadryl a week and a half ago. The little caplets had have red 40 in it, which did not agree. Well, I think I took like 8 capsules over a weekend. And then within 2 days, I thought I was going to die again. But anyways, I'm still here. I'm not going anywhere. I'm here to help you accomplish your financial goals. All right. That sounded ridiculous. All right, next up, U.S. labor market softens as job openings drop. Layoffs at highest level in over 2 years. Oh, my Lord. The U.S. job market continued to show signs of a softening in March, with job openings falling for a third straight month and layoffs increasing to their highest level in more than 2 years, according to the monthly job openings and labor turnover survey, JOLTS report. From the Labor Department, there were 1.6 vacancies for every unemployed person in March, the lowest reading since October of 21 and down from 1.7 in February. However, the labor market remains tight, with the ratio still higher than at any time prior to November of 21. The declining ratio of job vacancies to unemployment in the last 3 months represents a reduction in excess demand for labor that will be welcomed by the Federal Reserve, which is closely watching this ratio. The central bank is expected to raise its benchmark overnight interest rate by another 25 basis points to 5.25% range on Wednesday before potentially pausing its fastest monetary policy tightening campaign since the 1980s. It's like they have this sentence just pre-plugged: the fastest monetary policy tightening policies campaign since the 80s. I mean, yes, we know. You've been saying this for a year now. Let's see. Job openings, a measure of labor demand, were down 384,000 to 9.59 million on the last day of March, the lowest level since April of 21. Data for February was revised higher to show 9.97 million job openings instead of the previously reported 9.93 million. The decline in March was concentrated in small business, those with 1 to 49 employees, the main drivers of the labor market's phenomenal growth. Phenomenal. Sound like Jim Rome. Phenomenal. There were 144,000 fewer vacancies in the transportation, warehousing, and utilities industry. Professional and business services job openings declined by 135,000. Retailers reported a drop of 84,000 in vacancies. There were notable decreases in healthcare and social assistance, but educational services reported an additional 28,000 job openings. There were 34,000 government job openings. Yeah, because we need more people working for the government who are parasites and are stealing our money. Yeah, that's great. I'd personally arrest them with all the politicians and send them off to the gulag in Alaska until they paid back every cent they've ever stolen from people like me. Let's see here. Hiring was little changed at 6.1 million, keeping the hiring rate unchanged at 4%. Economists expected slowing demand for labor to be replicated in April's employment report, scheduled to be published on Friday. Non-farm payrolls are expected to have increased by 179,000 jobs last month, the smallest gain since December of 20, after rising 236,000 in March, according to a Reuters survey of economists. The JOLTS report showed layoffs jumped by 248,000 to 1.8 million, the highest level since December of 20. The increase was led by the construction industry, which shed 112,000 positions. The decline likely reflected the job losses in the housing market, which has been hammered by higher mortgage rates. Accommodation and food services lost 63,000 jobs, while the healthcare and social assistance category reported 42,000 layoffs. Employment in the leisure and hospitality sector remained below its pre-pandemic levels. With job openings steadily declining and layoffs rising, fewer people are voluntarily quitting their jobs. Resignations dropped to 3.85 million, the lowest level since May of 2021, from 3.98 million in February. The quits rate, which is viewed as a measure of labor market confidence, dipped to 2.5% from 2.6% in February. It is down from the 2.9% to 3% range seen in late 2021 and early 2022, when job hopping was at its peak. Insane. All right, so a lot of data there. Last bit of information here is U.S. factory orders rebound on aircraft in March. So a little positive news. I mean, the job market still seemed pretty tight, and now we've got factory orders coming in above forecast. So again, I'm not always doom and gloom. I try to bring a little bit of optimism to the party. I mean, I'm very optimistic of what's going to happen, 10 years from now, but it's going to be a bumpy ride between now and then. All right. New factory orders for U.S. made goods rebounded in March, increasing 0.9% after a 1.1% decrease in February. The jump was primarily driven by a surge in civilian aircraft bookings. However, the manufacturing industry is still struggling due to higher interest rates, with banks tightening lending following recent financial market turmoil and businesses cutting back on restocking in anticipation of weaker demand later this year. The ISM also reported its manufacturing PMI contracted for a sixth straight month in April, excluding transportation. Orders fell 0.7% for a second straight month. Orders for machinery declined 0.3%, while bookings for computers and electronic products increased 2.1%, and orders for electrical equipment, appliances, and components rose 0.8%. Shipments of manufactured goods fell 0.1%, while inventory of manufactured goods at factories dropped 0.8%. Unfilled orders at factories rose 0.4%. Orders for non-defense capital goods, excluding aircraft, which are seen as the measure of business spending plans on equipment, declined 0.6% in March instead of the 0.4% as reported last month. Shipments of these so-called core capital goods, which are used to calculate business equipment spending in the gross domestic product report, dropped 0.5% instead of 0.4% as previously reported. Business spending on equipment has contracted for 2 straight quarters. The manufacturing industry accounts for 11.3% of the U.S. economy and is being dragged down by the Federal Reserve's fastest interest rate hike campaign since the 1980s. Again, right there with that, you got to dive that in. With spending shifting away from goods typically brought on by credit to services, the sector is facing significant headwinds. The rebound in civilian aircraft bookings is a positive sign, but is unlikely to be enough to reverse the manufacturing industry's downward trend in the face of ongoing challenges. All right, well, that's all the good news that's out there. I mean, it's a little bit of a bright spot that factory orders are up slightly. But again, all you got to do is take a step back, look at the big picture and go, is everything in front of me good or bad? Do we have a higher likelihood that the markets are going to collapse and that the job markets are going to collapse and that all the dumb things that the Federal Reserve and our government has done over the last 2 years have helped us? No. I mean, yeah, it seems good in the moment. Yay, cool. I got $1,200. I can go spend it with this little gift card they gave me at the grocery store. Awesome. What you don't see is the billions and trillions of dollars that went into the pockets of the big business and, their crony friends. You got $1,200. I got nothing. So, unfortunately, that's if you make too much to get any of the freebies, but you make, you're under billionaire status, you just kind of get hosed in the middle. So, ow. Anyways, all right. Well, that's everything I had for today. If anyone needs anything from me, please go to dsafinancialgroup.com. All my contact information is there. I hope you have a terrific evening, and I'll talk to you next time. Adios.